Hello and welcome everyone. I'm Karthick Jonagadla, research analyst and founder of Quantace Research. This is the first episode of Filter Coffee with Quantace. First off, a huge thank you to all our clients and followers. Your ongoing support fuels our efforts and your trust in us is highly valued. You are indeed the stars of Quantace Research. Many of you have suggested that I share my market insights through videos to better disseminate our analysis and thoughts. This initiative is a direct response to the feedback received and to the people who have shown such great interest and support to us. Please like, share, and subscribe to Quantace Research for more detailed market analysis. Let's start with markets. The short term trigger, the April FNO expiry. We believe that the upcoming expiry rollover will be crucial for determining the market's next direction. We suggest that the investors keep a close eye on the April expiry FNO data. NIFTY analysis. Last Friday marked a potential turning point for NIFTY, in our opinion, as we saw substantial buying from market participants, especially from FIIs. This suggests a robust sentiment and could be indicative of an intermediate bottom forming in the market. As far as short-term market trajectory is concerned, our current assessment maintains that as long as Bank Nifty remains above 47,800 mark, there's a strong foundation for Nifty to revisit its previous high points. Critical support levels to watch out are 22,300 followed by 22,000, which will serve as support levels in the upward journey. Our preference is microcap, small cap, and mid cap stocks over the large cap stocks for the next 4 to 6 weeks. Talking about our current sector focus, as outlined in our recent small case updates, we continue to recommend manufacturing, metals, real estate, mobility, and pharma stocks. These sectors have shown resilience in the past and has the potential for growth amidst the current market dynamics. Moving on to the hottest sector in focus right now, metals. Broadly, the metal sectors can be classified into three categories: ferrous, companies that make steel; non-ferrous, companies that make non-steel like aluminum, zinc, and copper; and others like coal sector and structural steel tubes. So let's look at what the market expects. The street expects the ferrous companies to earn less. Why? The prices they get for steel have gone down and they're paying more for coking coal, which is needed to make steel. So the ferrous steel manufacturers are selling more steel than before because of the seasonal demand, but it's about same as last year. For non-ferrous, the market expects them to earn more, especially companies like Indalco and Nalco should make more money because they are shipping more steel and sorry, not steel. They are shipping more metals and costs for coal and power are lower. The prices for these metals are stable, which helps these companies. As far as the coal sector is concerned, the street expects tough time for Coal India. They are expected to make less money this quarter because their costs have gone up, and the extra money they usually get from auctions have decreased. To sum up, what does the street expect? Companies making steel will have a hard time because of lower prices and high costs. Non-ferrous companies making other metals might do better because their costs for coal have dropped. Coal India might not do as well because they are making less from auctions. So, wait. Let's introduce the dragon in the room, China. China has been trying to get its economy back on track with several initiatives recently, but the success seemed slow initially, leading to a pessimistic outlook for the metal sector. However, recent GDP numbers, which were announced last week, turned out to be unexpectedly positive, showing a growth of 5.3% for the first quarter, surpassing the expected 4.8%. This has sparked some optimism in the market. A strong recovery in China, often referred to as the world's factory, could have a significant positive impact on the metal sector. Why? This is because China consumes a large portion of global supply of various metals for its manufacturing and construction industries. The recent surge in copper prices hitting a 15-month high is a direct indicator of growing investor confidence in China's economic recovery. The rise in copper prices is largely due to expectations of increased manufacturing activity in China, boosted by demand from the US. You want to know what is the recent price performance of copper mining companies? Go check out Hindustan Copper. If China's economy continues to recover, the market expects a strong demand for metals, which would benefit metal stocks. Now, let's introduce Quantace's metal star basket. A lot of our current Quantace customers and potential customers had requested us to make a video on what makes Quantace's metal basket unique. But before we continue, let's explain some key terms. The live performance which you see is maintained by Small Case, and it is a third-party independent platform, and it depicts the actual and verifiable returns generated by baskets of Quantace Research. Live performance does not include any backtested data or claim and does not guarantee future returns. And as far as disclosures are concerned, by proceeding, you understand that investments are subject to market risk and agree that returns shown on our platform were not used as an advertisement or promotion to influence your investment decisions. This is purely for information purpose only, so that our investors are up to date and take better informed decisions and not some random one-off investment decisions. We are not a run-of-the-mill quant, like which does factor investing with little or no effort on risk management. We are Quantace Research, and 50% of the work we do is risk management. We have developed our 11-point framework to assess the quality of returns and how it is produced, rather than just focusing on pure returns like what others do. Let me just show the metrics. Out of the 11 metrics which we have developed, right? So let me go one by one and explain each metric which we use in our assessment. One is obviously the live returns. This is the absolute returns that we have generated, and how to read it more the better. And next is annualized returns. It's nothing but the absolute returns in annualized terms. And as far as annualized volatility is concerned, it's a proxy for risk, and it has a number associated with it. So the lesser it is, the better. Risk adjusted returns, obviously, it is not the returns that matters, but the risk you took to produce that returns. That is what matters. So the more it is, better. Next is number of times positive. So this is nothing but number of times the daily returns were positive. So more, the better. Next is beta, which is nothing but sensitivity to the benchmark. So lesser it is, to better. And next is max drawdown. It is the maximum drawdown seen from peak to trough. And the lower the number, the better it is. And next is nothing but the average of these peak drawdowns. The lesser the number, the better it is. And the number of drawdowns, again, lesser than drawdowns, the better it is. Next is the average recovery time. It is the time taken to recover back to the peak. Lesser the number, the better it is. And the last one is a risk metric. Like it is the average of the worst 5% returns uh, shown by the basket. So uh, the lesser the number, the better it is. So I mean, let me just show you the live stats of what we have achieved in last 2.4 years. If you look at the 11 metrics which we have developed, right? Like out of that, 1, 2, 3, 4, 5, 6, 7, 8. In 8 of the metrics like which we have developed, we have done better than the benchmark. And we do apples to apples comparison here, and we do not compare the metal basket of ours with the overall market. We would rather compare it with Nifty Metal Index, which is a better proxy for how the metal index has performed. So all our analysis is benchmarked against the metal index. So if you look at the live returns like which we have just produced, like it's close to 74% delta. So if you look at it, the index, the metal index itself gave close to 60%, whereas like we stand at about 133%. So that's the reason why I say our delta is like very close to 73, 74%. And we have taken more risk than the benchmark. So slightly more, like 1% more, but it is very well compensated. So the risk adjusted return is about like 1.6 times, whereas for the benchmark it is 0.8. It is almost twice than what we have seen for the benchmark. And we have ended up being in positive territory for 57, 58% of the times in the last 2.4 years. And if you look at it, our maximum drawdown is like lesser than what the benchmark has shown. And our average peak drawdowns is about like 4.7%, whereas the benchmark metal index had fell about 6.2%. Yes, we did show more drawdowns than the benchmark. But if you look at our average time to recovery, it's about like 21, 22 days, whereas the benchmark took about 33, 34 days. And this is how our graph looks, absolute returns graph. And this is the delta like which we were talking about. And if you look at across time frames, like the returns have been consistent, 1, 2, 3, 4, 5, 6, 7, across all 7 time frames, like be it as low as like 1 month to like right up to 2.4 years. Like it's an all-round beat. We have done better than the benchmark. And this is the most important metric in our opinion, which is the quality of returns. If you look at the drawdowns, like which we have shown, right? So if you look at it, like most of the times, like we have showcased like lesser drawdowns than the benchmark, and that is the reason why the quality of returns matters, and it's not just about the returns like which we produce. So So, in short, investors should note the resilience as shown by the shorter average recovery time of 21, 22 days and remain patient during drawdowns, considering the long-term growth trajectory. Thank you for watching. Your feedback is crucial. So let us know your thoughts or questions in the comments below. Stay informed and empowered in your investment decisions. See you from Quantace. Bye.